The financial system is failing. I'm your host, Steve Van Metre, and thanks for joining me today. We've been warning that if central bankers continue to tighten monetary policy, that they push the system to the brink of failure. Well, that day is here. Let's go to Bloomberg, where we picked today's story up with a headline: Fire sale risk in bonds pushes the Bank of England to step up measures. It's the second time this week the central bank has added to its arsenal of tools aimed at curbing market turbulence that, ironically, it created. The move, coming on the heel of Monday's record sell-off in inflation-linked debt, has immediate effect of bringing some calm to the markets. Now, many have been wondering what's been driving interest rates higher, particularly yesterday. Right now, it's all centered around the Bank of England and how they're losing control of their own bond market, and that's causing global rates to continue higher. Ever since the new chancellor announced a vast package of unfunded tax cuts, UK markets have been gripped by turmoil and the threat of a collapse as a key part of pensions industry. The funds are a major owner of inflation-linked debt and have been selling UK assets in the wake of collateral calls that triggered the spiral of bond market losses. And again, I want you to understand that this began when the chancellor said, we're going to have a bunch of tax cuts. We have no way to pay for them. And the market said, hey, wait a minute, that's going to be inflationary. You don't have the money. And that means rates have gone up and putting even more stress on the system. As you're about to see, it's far worse than you can even imagine. That expands the scope of bond buying program initially of long maturity gilts. The emergency measure was intended to buy time for liability-driven investment funds at the heart of the gilt sell-off prior to the Bank of England's intervention. To protect themselves from further spike in yields, the central bank noted it had made substantial progress. But dysfunction in this market and the prospect of self-reinforcing fire sale dynamics pose a material risk to UK financial stability. And this is something a lot of people don't understand, that our global monetary system was predicated on one key factor, that rates, even if they did go up, that it would be transitory, that the trend for rates over the long term would continue to be lower, because if we did face a big spike in yields, it would turn into a financial crisis. And you're about to see firsthand why this is such a big problem for the Bank of England and what's really going on underneath with the pensions. Some pension funds said the Bank of England's bond buying intervention should be extended till the end of the month and even beyond, perhaps in perpetuity. Other funds suggested additional measures be put in to manage market volatility if purchases are ended. And separately, a central bank also paused the sale of corporate bonds, notably that it couldn't get rid of all of them. It accumulated during quantitative easing and confirmed that gilt purchase operations would only continue until October 14th, which we can only guess will be extended then. These additional operations will act as further backstop to restore orderly market conditions by temporarily absorbing selling of index-linked gilts in excess of market intermediation capacity. So what the whole point is, the Bank of England believes there's demand for these bonds, but the market just can't handle it right now. So they're just trying to tap the brakes. They think, well, we could just buffer this a little bit and then it'll smooth out and everything will be fine. And what happened already is they found out that things aren't fine. They're going to try it again, and they'll find out once again that just how close the system is to being on the verge of breaking. And now let's go to the Wall Street Journal, and we pick up the second part of the story where you see just how bad things really are. The Bank of England offers more support for pension funds amid the crisis. At the same time, pension funds have been reluctant to sell government bonds they hold at the Bank of England, a point that we made out in a recent show where I said, look, they don't want to sell these bonds. It's not how the system works. And sure enough, the Bank of England came in and said, look, we'll buy bonds so you can sell them. And guess what? The pension funds, they didn't sell them because they don't want to. And you're about to see why. Pensions hold government bonds as a way to hedge against interest rate changes, which determine how their future liabilities are valued. Pensions would likely take a loss, key word loss, which is why they don't want to sell, by selling now, given the price off over the past few weeks, because pension funds usually buy and hold to maturity and are required often by regulation to buy government debt, and that would mean they would only need to rebuy them later at a higher price to rebuild their hedges. They might be reluctant to sell gilts because they might need to get that exposure back later. No doubt they will. The lending programs announced Monday include what the Bank of England called a temporary expanded collateral repo facility. This lends cash to pension funds in exchange for an expanded menu of collateral than was previously available to the pension plans, including index-linked gilts, whose returns are tied to inflation, and corporate bonds. So the first step now is you see the Bank of England acknowledging that, hey, there's something's wrong in this system. So rather than continue at least doing this QE, which they're going to do anyways, they've also given these pensions another chance to get out by saying, look, you don't have to sell your bonds if you don't want to. We'll just swap you them for a short-term loan and give you the cash until you work through whatever problems you're having. Of course, we'll turn a blind eye to that and hope that in a couple weeks that everything's going to be okay. But what you're about to see is the real problem with these pension funds, and this real problem doesn't just exist within the United Kingdom. It exists throughout the world, and this is why we'll ultimately see rates head back down and to new lows. Let's continue on. The crisis centers on a corner of the market known as LDIs, or liability-driven investments. LDIs became popular in recent years among UK defined benefit pension plans to make enough money in the long term to match what they owed retirees. These strategies use financial derivatives or leverage tied to interest rates. Now, I want to make a key point here before we go forward, is that these derivatives, these strategies were not tied to rising rates. They were tied to falling rates. So that means that they were trying to hedge that if rates went down, that they could generate more return. Now, if rates go up, guess what happens to these positions? Yeah, they get blown up in a big way. That's the problem. LDAs also contain leverage, shocking, or borrowing, also shocking, that amplifies pension fund investments by as much as 6 or 7 times. So again, you see this leverage built up in the system that's predicated on lower and lower and lower interest rates. What happens? We get inflation, central banks panic, they go crazy driving rates up, and they push the system to the brink of failure. And what you start to find out is not just the UK pension funds that have leverage. What we will ultimately find out is there's leverage throughout the entire global monetary system. When the long-dated UK government bond yield as under-grid LDI investments surged more than they ever have in a single day at the end of September, LDI fund managers required pension funds to post massive amounts of fresh collateral or cash to back up their investments, hence the need for the pension funds needing cash. The point of the new lending programs and the bond buying is to make it easier for the pension funds to drum up cash so they can pay down the leverage on their LDI funds without causing wider market disruption. And so what you can see is you see the case of why central bankers will ultimately come back into the market, why this seeing the yield curves inverted, why the Eurodollar's futures curves inverted. They're all telling the central bankers, look, we already know that you're going to have to ease and you're going to have to drive rates back down below where they were before, because the entire system is over leveraged on a bet of lower interest rates and will blow up on the case if rates stay high. But one thing that shouldn't blow up if rates stay up and central bankers screw this up again is your portfolio. I'll put a link up here to Portfolio Shield and description below, because many people have said, Steve, I can't see this dollar shortage you talk about. Well, the Swiss National Bank has one of at least 3 trillion. Here you can see central bank liquidity stops operations from the New York Fed. We know that the Swiss National Bank recently, as of last week, took $3.1 billion in cash on a sign that things over there aren't so good. And compounding to that problem, we turn to Morgan Stanley now, who's taking stock of an inventory problem that will only compound this problem central bankers are facing. And the problem with inventory is twofold. They say supply chain bottlenecks are clearing while demand, especially demand for goods, is slowing. Consumers have overspent, shocking, on a number of goods-related items, especially durable goods like furniture, tech products, and leisure equipment, as a result of COVID lockdowns. Now, what they should say, as a result of too much stimulus driving demand, and then the immediate withdrawal of all that stimulus and monetary support, leading to a big drought where consumers can't afford all this inventory that's starting to stack up. Goods consumption on a real basis has been declining since the second quarter of 2021, is now back near trend again as fiscal and monetary spigots were turned off. We're expecting overall demand to slow beyond payback in overconsumption of goods. No surprise. While consumer confidence has rebounded from all-time lows observed this summer, it remains weak, and we expect consumers to pare back spending. And that they're right. Morgan's got that right. Here we see the University of Michigan Consumer Sentiment Survey in blue, overlaid with the advanced retail sales in red, that one on a year-over-year rate of change. And we note that as consumer sentiment heads lower, that eventually demand and spending falls, meaning Morgan's got this right. We're about to see a big slump in spending at a time when inventory levels, as you're about to see, are sky high. Inventory to sales for the median U.S. company has been on the rise since the financial crisis, is now at the highest level, get this, since 1990. And inventory to sales ratios have increased substantially and are sitting at elevated levels in the consumer staples, industrials, and tech sectors. The median company within the good-producing industries has seen a whopping 19% mismatch between inventory and sales growth. Our transportation team shipper survey revealed that net ordering levels dropped to off-the-chart levels, minus 40% year-over-year decline, not seen in 12 plus years of the survey. So again, we're seeing more signs that the global economy is hitting a wall and is yet to get here, but it's coming, and you're seeing it now in the shipping industry. Simultaneously, net inventory levels also rose sharply, albeit not to record levels. These are inventory levels last seen in 2018 as we built up inventories into tariff risk, only to destock through 2019. Almost half of respondents say that their inventory is higher and ordering is lower going forward, which firmly indicated an over-inventory destocking condition. And we know that when inventories get too high and they start to cut new orders, what does this mean for the economy? It means oil prices are likely to go down. Inflation will likely come down. Interest rates likely also go down. How about unemployment? Well, yeah, that one is headed up. Faced with the glut of inventory, companies will need to decide whether they want to accept high costs to continue holding inventory, destroy it, or keep prices high and take a hit on the number of units held, or slash prices to stimulate demand. We believe many will turn to aggressive discounting, hence deflation, to solve their inventory problem, which is likely to spark a race to the bottom as companies attempt to cut prices faster than their peers and move out as much inventory as possible. But this has left, of course, us now looking at the PC industry. We see shipments there are plunging nearly 20%, the steepest drop in more than 20 years, as back-to-school sales were weaker than expected despite promotions and price drops. Here again, we're seeing that, again, it's not an issue of price. Consumers just don't have the money they had before because of inflation. And of course, we're seeing these companies try to lower prices and consumers saying, hey, I can't afford it, not at any price, and that's going to be a huge problem. The U.S. market for PCs declined a whopping 17.3% in the third quarter, driven by a slump in laptop sales. But one thing that's not slumping is small business optimism. Well, at least it's not off its lows now, as it improves for a third straight month, but remains very poor. The survey's inflation metrics continue to ease as the net share of owners raising prices fell 2 percentage points to 51%, the lowest in a year, but still elevated. Almost a third of owners plan to increase prices over the next 3 months. We'll see how that goes, and the smallest share since January. Inflation and worker shortage continues to be the hardest challenges facing small business owners, and even with these challenges, owners are still seeking opportunities to grow their business in the current period, which is something that all small businesses should always do, is always seek to figure out how to grow their businesses regardless of what the conditions are. But if they're worried about a lack of employees, well, the stock market keeps going down and the financial system breaks, what they're going to have is just the opposite problem. Too many people are going to need jobs. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.